Hi everyone, I'm Brandon and welcome back to NewsForTeens. So what was all the frenzy with GameStop last week? You know that store in the mall where you can buy video games and gaming hardware? Just a year ago, its stock price was as low as $2.57 per share. Last week, it went up to a record high of $483 per share. Based on articles I've read and podcasts I've listened to, here's a summary of what I've learned. There are at least two factors that caused the massive growth of GME stock. The first reason is that some people fundamentally believe GameStop has a future in e-commerce. You see, GameStop makes most of their money by selling games and consoles in their physical stores. But now, many of us buy our games online, and especially so during the pandemic when many malls have been closed. With GameStop depending mostly on in-store sales and consistently reporting losses, its stock price was in the single digits for a while. However, at the same time, some people believe GameStop could halt its decline and reverse its course by investing in its online business. Ryan Cohen, the founder of multi-billion-dollar company Chewy, which sells pet supplies online, was one of those people. He invested millions of dollars into GameStop back in August. In November, he wrote to the GameStop board, urging them to focus on their online business. They liked his ideas and offered him a seat on the board in January, along with some of his former colleagues. Within the first 10 days of him joining, the price of GME stock had more than doubled. And then from there, the stock skyrocketed. Many would attribute the second phase of growth to Reddit. Some call it a story of David and Goliath, or a battle between retail investors who are individual non-professional investors and institutional investors, companies or organizations that invest money on behalf of other people. So what happened? On a subreddit called Wall Street Bets, Redditors recognized that institutional investors were undervaluing the stock so much that they were overexposed. They saw an opportunity to take advantage of the situation. How? Well, at the time, GME was one of the most shorted stocks in America. Investors that short stock are placing bets that the price of the stock will decrease. They sell high and buy low, but they aren't usually selling stock that they own. When investors short a stock, they typically borrow someone else's stock, sell the borrowed stock at a high price, wait for the stock price to drop, buy it back at the now lower price, and then return the borrowed stock. Shorting a stock is legal, but it can be risky. Many of the people shorting GameStop were institutional investors running hedge funds. The Reddit investors believed that if they bought the stock, they could force the stock to hold its price or even increase in price. This would force the short sellers to buy back their shares to cover their losses. And while doing so, the short sellers would boost the share price even further. This would in turn force more short sellers to buy back shares, further boosting the share price. This is known as a short squeeze. And so the cycle continues until the short sellers have covered their losses. Last week, it seemed like everyone was talking about GameStop. Even Elon Musk was commenting on the action. At one point, Robinhood, an app people use to trade stock, and commonly used by the Reddit crowd, suspended the buying of GME stock. This was highly controversial, as many believed that this action was due to pressure from powerful institutions losing money on GameStop. Robinhood received lots of criticism for this decision. Even AOC described the action as unacceptable. So where does this leave us now? While the whole GameStop frenzy may be over in a matter of days or weeks, the situation has shown the world that independent investors, if united, can move the stock market and influence those who trade professionally. Thanks for watching. I hope you learned something new and are looking forward to my next video.